finance and will be returning to this industry post-graduation. Today, we have people joining together from all around the world. So good morning, good afternoon, good evening to each of you. I want to first thank everyone for taking the time to join us today. These continue to be difficult and uncertain times, and we wish you safety and health above all else. Our goal in putting together today's webinar is to gain a deeper understanding of more than just the economic and business ramifications of the pandemic, but what the outlook across various industries and geographies might be on the other side, the day after, so to speak. We can all read the headlines: market volatility, capital flight, GDP forecasts, currencies depreciating, staggering unemployment claims. Just today, a headline in the venerable Wall Street Journal highlighted Vietnam's stellar health response to the pandemic, but in the next breath focused on growth forecasts from UBS, which seem to indicate that they might revise those downward further. So if you have a bit of headline fatigue, know that you're not alone. We're thrilled that you've joined us here today for this webinar because we intend today to be just a little bit different, to offer a different perspective, a global perspective that looks to the future, to tomorrow, to the day after. Here to do that with us are three fantastic guests joining us from all around the world. As usual, when we conclude today's webinar, we hope that you will have enjoyed yourself, learned from our esteemed guests, and gained inspiration not just for today, but for all the tomorrows that lie ahead. The format of today's webinar will be as follows. We have three distinguished panelists lined up, each of whom will speak for about 10 minutes. When they have concluded speaking, we will open it up for Q&A. Please use the Q&A tool at the bottom of the webinar screen to submit your questions. We will be selecting questions submitted there and there only. At the conclusion of the Q&A, we'll be treated a commentary from Lourdes, the director of the Emerging Markets Institute, before we wrap up this special webinar. And with that, it's time we begin. It is my pleasure to introduce Thomas Deng, our first panelist. Thomas is regional CIO for Greater China and chief China strategist at UBS Wealth Management. Formerly, Thomas was deputy CEO and head of investments at Invesco Great Wall Fund Management. Prior to Invesco, Thomas was at Goldman Sachs, where he was a managing director and chief China strategist in the Global Investment Research Division. Thomas earned his BA in International Finance from Wuhan University and master's degrees in both economics and statistics from the University of Utah. He has completed the advanced management program at Harvard Business School and is a CFA charter holder. Thomas is joining us from Hong Kong. Welcome, Thomas. The floor is yours.
Thank you, Matthew. Can you guys hear me? Okay, great, yeah. Thank you, Matthew, and thank you, Lourdes, for inviting me to join this webinar. It's my pleasure and privilege to have this opportunity to share my thoughts on China's macro as well as asset class from here in Hong Kong. As you probably know, I've been in following China equity market, China's macro research for the past 25 years. I have, for good or for bad, I experienced a number of crises, and to say the least, the current crisis, I've been through the 97, 98 Asian financial crisis, as well as 07, 08 global financial crisis. So this is so far the most challenging crisis, but as I have seen, experienced over the past 25 years, my confidence is that this will pass and the market will recover as we have seen in the past. What I will do today is just to, over the next 10 minutes, I will share so far the policy response from Chinese government in response to the outbreak of the pandemic and its impact to various asset classes, then follow on our outlook on the overall macro as well as our strategy on asset allocation. So let me start with a quick review on the policy response. You've all seen the number from China. The first quarter GDP was negative 6.8%. That's by far the worst number we have ever seen since China reported the number. But we do expect so far a V-shaped recovery in the second quarter. But again, it will depend on how things will evolve. So far, from what I observe, in fact, on the ground, talking to people in Hong Kong, talking to business entrepreneurs in China, pretty much, for example, the electricity consumption in China pretty much return to the level last year. In fact, I happen to have a businessman friend who is the largest owner of small hydronic power production in China. He said his overall production actually exceeded last year. So that's just good indication that overall economy so far has been recovering nicely. And what we have seen the policy response from Chinese government in terms of on the policy on the economic front as follows. First, on the fiscal policy front, we're seeing China launch it pretty much resort back to its old playbook. That's the government spending 10 years ago. It was on only infrastructure, high-speed rail, the airport, the highway. But this time, China is actually investing in the new infrastructure. What do we mean by new infrastructure? It's basically the 5G, the infrastructure for a new electric vehicle. So what we expect is this will actually lay the foundation for the long-term growth of China's economy once everything gets back to normal. Just like what 10 years ago, people were worried about whether there will be enough demand for high speed and for high-speed rail and highway, railway, and then economy recovered and now become extremely profitable. This time again, Chinese government is doing the same to boost the economy, to lay down the long-term foundation for growth. And in the same time, the government is trying to boost the consumption. It's quite interesting, actually, a very different local government level, the government officials right after the relief or the lift over of the lockdown, and the government were giving out the consumption coupon to consumers, and the government official actually showing an example to go to a restaurant to show to the public that, look, we'll go back to restaurant and we eat, everything is fine. So they were doing both handing money out as well as doing it, show to the public that it's safe to consume. So that's on the fiscal policy front. On the monetary policy front, of course, just like the playbook that we have seen in all the major economies, cutting down interest rate, flooding the market with liquidities, except that the Chinese government is actually, or central bank, is actually doing it with a more measured way, rather than aggressively cut interest rate to the bone. China is actually quite controlled manner rather than being aggressively flooding the market. So overall, what we have seen together with other policy response, we have seen, as we mentioned earlier on, now the economy has actually recovered pretty much to the pre-crisis level, at least from the economic activity front. And in terms of impact to the different asset classes, like equity, fixed income, currencies, or on the property market. On the equity market, you have already seen China accounts for 40% of MSCI emerging market, and so far been the most stable component of this asset classes. For a Chinese domestic market index, either the Hong Kong listed shares, Hang Seng Index, or the Shanghai Composite Index, or CSI 300, which is equivalent of China's US Standard Poor's 500, has been remarkably resilient. In fact, it's largely Hang Seng Index is down less than 20%. The onshore market, which more reflecting the domestic economy, is down less than 10%, so pretty stable, and huge outperform the rest of other equity market. In terms of its the performance of fixed income, it's pretty much the treasury market. The Chinese government bond has done very well. That's natural as a result of the central bank interest rate cut. Currency-wise, the RMB or the CNY has remained largely stable relative to the US dollar, and in a way is probably strengthened against many other currencies that has sharply depreciated during the past couple of months. And the impact to the housing market is also quite interesting. It is quite localized. For the property market in Hong Kong has dropped quite a bit. We're seeing nearby people are posting on a property is down about 10-20%. But across the border in Hong Kong, in Shenzhen, the property market is actually going up quite strongly, about maybe 10-20%. In other tier one market in China, in Beijing or Shanghai, largely stable. So for some tier two cities inland China is also done quite well. So that's so far the impact on different asset classes. In terms of our outlook for China economy, apparently you probably read all different forecasts from IMF, World Bank. Our sense is it will hugely depend on how this pandemic evolves. So far, China as a country as a whole, the new cases pretty much bring down to double digits, less than 50. Most of the new cases actually imported cases. So by and large, the situation is being under control. Barring any major second wave of outbreak, we are reasonably optimistic that the Chinese economy overall for the full year might achieve a positive growth around 1% to 3%, despite the negative 6.8% growth in the first quarter. And for the next year, we are expecting a strong rebound. Again, barring a second wave, rebound for the cases. So that sets our outlook on an overall macro growth. And in terms of our recommendation to asset classes, still on the back of this potential strong recovery, our preference is still the Chinese equities. And within Chinese equities, more specifically, we like a few sectors that have secular long-term growth. That on one hand is benefiting from the new infrastructure investment, a cloud computing, the e-commerce, online education. This other sector has done extremely well during the crisis level. In fact, the share price has gone up despite overall market has been coming down. We see continuous driver, long-term driver for these sectors. The other sector we like a lot are the infrastructure, the healthcare related, that's the equipment, pharmaceutical research or biotech related research. These are the sectors that in fact has done quite well, will continue to do extremely well. Literally today we have one biotech company that listed in Hong Kong on the first day of the debut, the share price up 48%. So I have a few friends who invested as a private equity. I saw the news posting by those guys. They're quite happy, but we'll see whether. I think it's a huge trend. Hong Kong Stock Exchange launched this sector, allowing a biotech company with no revenue, with no profit, to be listed in Hong Kong. And that's similar to, this has never happened in the past. So they were just tapping this new sector, just shows the potential demand, the enormous investment opportunities in this sector. And we think there are great opportunities in this healthcare related sector as well. The other sector we also like are domestic consumption. In fact, there were quite a lot of interesting themes investing emerging out over during the pandemic. Instead of sales coming down and actually going up, and so that's more domestic related consumption scenes. So that's pretty much the asset classes. For globally as a whole, we think in a longer term, the equity will still outperform the bond. For Chinese currency, we think it will likely remain stable. With that, I will just take a pause there and then pass it to the next speaker. And later on, if you have any questions, I'll be happy to take the question after all the speakers' speech.
Thank you, Thomas. I thought very interesting, to think about the impact to the housing markets, you know, Hong Kong versus Shenzhen, the tier 1 cities being stable, you know, as a proxy maybe for economic activity and consumer confidence. As a reminder to our audience, please submit any questions you have in the Q&A tool that's at the bottom of the webinar screen. Thank you. Our next panelist is joining us from Ithaca, New York, where he is professor of economics and the Karl Marx Professor of International Studies here at Cornell University. Dr. Kaushik Basu earned his PhD from the London School of Economics and is the former Senior Vice President and Chief Economist of the World Bank. Prior to his role at the World Bank, Dr. Basu served as the Chief Economic Advisor to the Government of India at the Ministry of Finance from 2009 to 2012. He is formerly the Chairman of the Department of Economics at Cornell University, and on top of everything else is currently serving as the President of the International Economic Association. Welcome, Kaushik. The floor is yours.
Matt, thank you very much for the generous introduction. Thank you also, my colleagues, Lourdes and Gaurav, for organizing this very, very important event and bringing in people from around the world. One little correction I will make in Matt's introduction. He doesn't know where I'm located at this point of time. I'm normally, as he said, I'm normally in Ithaca, New York, but I was visiting India for some meetings in Delhi and stopped at my daughter's place in Mumbai for a few days before going for work to Delhi when the lockdown happened. So I'm sitting in my daughter's home in Mumbai, and actually getting a closer view. I've been watching the Indian economy very closely. I just didn't know that I'll be living in the field and doing my research. So that's where I'm located. Let me give you, first of all, a bit of a broad overview. The global economy is reeling all over. And as was just now pointed out by Thomas, that it will probably be a V-shaped recovery, but it's quite a deep V, because we know, for instance, for United States, the unemployment forecast that is coming out for the second quarter, 32% unemployment, that is bigger than in the Great Depression. But it's a very sharp fall, and we are all optimistic that it will pick up. One important thing that has to be kept in mind is that the reaction of the economy, what the economy is doing, the global economy, is not so much because of the pandemic itself, as because of the actions we are taking to control the pandemic and the way we are responding to this. This is very, very important, because in earlier pandemics, because we did not live in such a globalized, digitized world, the information would drift in slowly, people would react slowly, which is very bad for the pandemic. What is happening now is good for the pandemic. We are reacting very quickly. Information is flowing across the world. But there is also a sort of psychological overaction taking place. You talk to people who are in sheer psychotic panic about what's happening. I feel, frankly, this is a little bit to do with the connected age that we live in, where every moment on social media you're getting information. Because just to get the numbers right, where the pandemic today stands, right now it's much smaller, not only than the big Spanish flu of 1918-19, but it's still much smaller than the 57-58, what is called often an Asian flu, or the 68-69 was another flu. This is smaller than all of those. 68-69, I was around, lots of people are around, you tell them, they didn't even know that a major pandemic had taken place, bigger than what's happening now. So this is a sign of a connected world. We are reacting to it, which is all very good news. But there is a fallout on the economy side, which our disproportionate awareness is causing. And another thing has to be kept in mind, since I do want to focus on developing countries and in particular India, that between the kind of incidents you've seen in European countries and in North America, in Sub-Saharan Africa, Latin America, South Asia, and even East Asia, the numbers in terms of fatalities is actually much lower. And I do want to give you some numbers, because what's happening in developing countries, emerging economies, is we are picking up cues from the advanced economies and following a lot of the policies very verbatim, trying to do what they were doing. And we have to be aware that we are at a very different level in terms of the infection. Now, even while I'm saying this, I'm aware that I don't want people to feel comfortable that this is going to remain like this. We don't have to worry. No, you have to take every step to control the spread of the virus. But keep the numbers in your head. With the economy, you plan on your action. So let me give you a few numbers, which I won't even try to bring it onto my screen. I could have brought in. I'll read out a couple of numbers just to give you a comparative level. If you take 10 million people in a population, what number within that has died of 10 million people? In Spain, of 10 million people, the death now is 4,740. It's even higher in Belgium. Belgium is actually the leading country, just about 5,000. Spain, less than 5,000. Italy, 4,200. Sweden, 2,000. United States, 1,510. This is the number of fatality divided by the of 10 million people in the population. Of 10 million people in the population come to Latin American countries. We were just now seeing 4,000, 3,000, 2,000 in Northern Europe and United States. But Brazil is 160, not 4,000, not 1,000, 160. Chile is 90. Argentina is 40. Australia is 30. China is 30. It began in Wuhan, but China is 30. A couple of other numbers. India, since I'm going to talk about India, is 5. Kenya is 3. Tanzania is 2. Ethiopia is 0.3. And it is not just that these countries were isolated, not connected to the rest of the world. Ethiopia is very linked with China. People going back and forth all the time. Bangladesh, which has a figure of 8, is connected to the world. People are moving back and forth all the time, but these are much lower numbers. Of course, we have to be prepared for what it could do, but we have to be also careful with our policy. India, now let me turn to India. India took some early measures, which were tough measures on lockdown. And actually, I have to say that the numbers, as I just read out, have remained relatively low, flat, reasonably under control. The worry in the case of an emerging economy like India, all actually emerging economies, developing economies, is the COVID controls fallout on the economy. And indeed, concerns are being expressed about what is happening here. The lockdown in India is one of the most strict lockdowns. Very good for the first couple of weeks. It's managed to keep it under control. But I feel India will very soon, the lockdown lifts on the 3rd of May. We will have to begin to work very carefully, and this is true for a whole host of other emerging economies, in easing up the lockdown in intelligent ways. And I want to point to a couple of things that need to be done. During the period of the lockdown, you do want one big effort, which is converting hospitality, hotels, airline industry, a lot of the resource from that sector to the health sector, healthcare sector, and major moves are being made. In India, for instance, 5,000 railway coaches, since trains are not running, 5,000 railway coaches are being converted into quarantine rooms for 20,000 beds. So those kinds of efforts ought to go on very strongly, and a lot of these efforts are indeed taking place currently. Food subsidy, the cash subsidy, which was being given following United States, many other countries are doing, India's doing. Here, one word of caution, and India is beginning to act on that as well. See, giving cash subsidy to people in poor countries can cause one problem, which we know from the Bengal famine of 1943, where the poor people had cash in hand, but once supply chains of food broke down and food was not coming in, the rich were beginning to outcompete the poor. So the food prices began rising. So even if you had cash in hand for the poor, that cash is not enough. Prices will rise to exclude you. So the need is for direct support of food, essentials, and some health services. And this is being done. I know this is also being done in many places in Africa, South Africa, which has been in the forefront of some very, very impressive action. A lot of this action is being taken, and you have to be aware of that. Finally, and this will actually allow me to connect a little bit with what Thomas was saying. You know, beyond the point when the markets are frozen, we do want the government to step in, do deliver food, deliver cash, etc. But over here, I have to put on a little bit of my conventional economist hat and remind people, and we have to remind policymakers, that the government can't step in for everything. You do need private players, you do need the corporations, you do need the small private players, which is a huge sector in Africa, in India, the informal sector, for them to be able to run their businesses. So the lockdown has to be eased up in a way so that the invisible hand, so-called, of the market gets some space to play out. Because if you keep the lockdown very, very severe, what will happen, and this we have already seen in the month of March, India saw an outflow of capital, which is the biggest in a single month ever seen. And this is, of course, the markets are reacting to the lockdown and moving their money out of the country into other places, and the rupee is losing value. Interestingly, South Africa, which has also been in the forefront of some of this battle, is seeing a big exodus of capital and also seeing the South African rand losing in terms of value. So this is where you have to create space for the private players, for the small businesses, and needless to say, for the workers. Because for the workers, the suffering, I gave you the American number, the expectation is that the unemployment is going to rise to 32%. It has probably already close to that, which is an all-time record for the recorded history of the United States, because it was 24% during the Great Depression and now inching towards 32%. In India, unemployment is not measured as well because the notion of employment kind of work you do is harder to measure. But some of the best groups that measure unemployment, they are predicting that unemployment is going to rise very quickly to 24%. Less than in the United States, but for an emerging economy, this is very harsh. For a lot of the people, the migrants, the workers, this is turning out to be a very, very hard period. So my very simple suggestion, and I've been writing extensively on this, is yes, you reach cash support, you reach food support, you make space, but you also have to gradually unwind from the lockdown, allowing factories to run with rules in place. Maybe you want to have that only 1/3 of the workforce can come in at any point of time. You want to have social distancing, but with that you have to open up, allow the economy to churn, so that the description that Thomas gave of the nature of the recession, whereby the economy plummets down, after that it picks up very quickly and does not remain over there for a very long time. And that is what one hopes for. One final word about Africa, I should point out that Africa, I have been doing some research on Africa right now. It's a similar situation in South Asia and in Africa, but in Africa, the informal sector is even bigger. And when you have a blanket lockdown, then the informal sector, which is used to working in the shadows of the law, suddenly gets completely stopped because you're not allowed movement, you're not allowed to move things. That informal sector, you need to pay a lot of attention. In the beginning, you may need to freeze it and reach food and other kinds of support. But once again, you have to create avenues for the informal sector to work, for the poorest people to come back to work and begin to fend for themselves along with support from the government. With that, let me stop. And if there are more questions, I'll be happy to come back.
Thank you, Kaushik. I think I enjoyed you putting on your economics hat for us, bringing in a little Adam Smith, invisible hand, reminding governments the world over to think about making space. I will admit that the statistic about deaths per thousand, I thought initially might be a bit depressing, but I was pleased to find out that to some degree it actually offers quite a bit of optimism for emerging economies. So thank you very much. With that, we're going to move to our third and final panelist today. Is joining us from Nairobi, Kenya. Paul Kavuma is the Chief Executive Officer of Catalyst Principal Partners. It's a leading Nairobi-based private equity fund that works across East Africa with primary focus on Kenya, Tanzania, Uganda, Zambia, and Ethiopia. Paul has more than 20 years of management consulting, entrepreneurial, investment banking, and private equity experience. Previously, he was a director and head of East Africa private equity at Actis Capital. And before that, he was at HSB Investment Bank in London and Johannesburg. He holds a Bachelor of Arts from Brown University in both economics and engineering, and an MBA from the Johnson Graduate School of Management, class of 1993. Welcome, Paul.
Thanks very much. And I'm going to actually share some slides, if that's okay, to talk through. And I will start sort of very briefly around the macro. But given the quite a powerful presentation by the earlier speaker, the economist, I think I'm going to try to offer a more practical approach as a private equity investor and the impact that it's had on our day-to-day life. I have to first apologize for being a little bit late, but I will give my excuse early in that the bank that we use as our manager for our activities just about a week ago went under in Mauritius. To give you a sense of the impact on our lives, went under unexpectedly, and so having to deal with liquidity crunch crisis even from our own operations is the reality of our day-to-day life, and clearly a few things of import that I'm dealing with as a result of that. But just to give, I'm hoping that everyone can see this just very quickly, starting from the macro, because I thought I'd just put Africa into context first. The rest of the world clearly is way up ahead of us in terms of numbers and cases. Africa, we are still quite relatively far behind. So 75% of all the cases are in Europe and the US, with Africa and Latin America being less affected. That's sort of at the headline so far. Let me see if I can. But then when you look within Africa, and I'm focused on the Eastern African market, I just thought you should understand Africa is also not one continent. It is one continent, but not one country, obviously, as we all know. And actually, the impact of COVID has been more pronounced, both in the number of cases and also its impact on the economic activity across the region. We have a disparity between the mineral export nations and the oil export nations, and the COVID impact. Both of those two things are the big drivers of economic activity. And if you look at the Nigerias or South Africa as the big economies of Africa, they have been more export, mineral or oil export driven. Whereas in East Africa, we're the opposite, where we're importers of net importers of oil. So actually the oil prices where they've gone to today has actually been a blessing for East Africa because the impact of COVID has been pronounced. And if we had taken the double hit of the oil prices being a major factor and COVID, it would have been a very much more material impact. And you will see what that those two combining forces, the impact has had on our economic outlook for the two regions. But certainly in East Africa, we have seen a fair amount of disruption from the global supply chains. We are very pleased to see China coming back quite strongly. We have a lot of imports into our manufacturing industry from China. India continues to be somewhat problematic, although and spotty. So we're still seeing some challenges there. We have a high dependence on foreign direct investment into our region, which we have seen slow down dramatically, as one would expect. But equally, remittances, which is a major flow of foreign exchange into our region, has also slowed down significantly, as you would expect. So if it had not been, although we have seen some pressure on our currencies as a result, it's really the offsetting impact of the oil prices which has meant that we've seen only modest impact on depreciation of our local currencies. The benefit of this COVID virus coming to us after it's been elsewhere is that we were a bit more prepared in terms of the interventions of government. So the restriction on the movement of people and goods has been actually, I think, quite well, we've prepared ourselves quite well in the region. And we have still managed to keep goods moving within the region, certainly in East Africa. The intra-regional trade, although disrupted, we have been able to maintain some level of flow of goods and services across the borders. I should say that, one of our challenges, our biggest challenge, is that while government is intervening and there's some stimulus packages we are benefiting from, given the last 10-year investments in infrastructure and services and government efficiency, our balance sheets were already under some pressure collectively across the region. And so we don't frankly have the wherewithal to really pump the economy for any particularly long period of time. So this short, sharp shock approach of trying to sort of contain the spread of the virus, particularly with our weak healthcare infrastructure, is really the approach that almost needs to be taken. And generally, although it's not universal, generally this appears to be working. The previous speaker did speak to the most exposed, the most vulnerable populations, particularly in the dense urban centers, and that has been a very big factor. The truth is that we're already beginning to see some elements of social unrest. Most people who live on a daily wage are not able to stay home for 3 weeks or 4 weeks without a check. And so while governments across have been making efforts to provide basic essentials to the population, again, our capability just from a funding perspective and even just the logistics of trying to get essential goods to people has been a challenge. So this shock therapy approach really is the only way that we could have contained this virus. This is a busy slide, but I think I'm just trying to distinguish maybe on the extreme left-hand side of this over here. Sub-Saharan Africa, you would think the whole economy post-COVID is going to be in recession. In fact, that is not the case. If you look at our East African economies, broadly, much more broad-based economies, not very dependent on mineral exports or oil exports, we're clearly seeing compression in our growth across the region, but still positive GDP growth rates we're expecting here. But if you look at the oil exporters over here and the mineral exporters, South Africa, very severe impact on GDP growth rate. So if you look at East Africa, we would be closer to where we think the other emerging economies might be, whether it be China, India, with some major impact, but less pronounced than maybe other economies. And then maybe just speaking to my daily life, we have a portfolio of investments in FMCG businesses, in banking, in equipment leasing. It's a generalist fund. So what are we facing? What are the consequences on our businesses? Well, having sort of we were just as a region emerging from the last global shock, let's say, the last global commodity crisis that we had in the sort of 2015, 2016 period. And so if we had already a couple of years of pressure on our growth in the region. So, and I mentioned from a public finance perspective, our balance sheets were slightly under pressure. I'd say that's similar across the economy. So we already had we were sort of looking forward to relatively faster growth in the coming years. And in fact, that has been tapered dramatically. We're expecting demand clearly to soften across the region. With certain sectors like the tourism industry, in Kenya, that represents about 15% of our foreign exchange earnings, is been decimated. I mean, our hotels are empty, and there's a huge knock-on effect in terms of employment and across the economy. Budgetary pressure, we feel, is going to likely cause inflationary pressure. and exchange rate pressure. And broadly, we're seeing a significant tightening of liquidity across our portfolio with the shocks to production and consumer spending. So as a manager of assets, of businesses, what have we been doing? First, ensuring compliance. At least we are doing our part to contain the virus. A lot of cost rationalization, which unfortunately means a fair number of layoffs, which is going to compound the social impact, unfortunately. A lot of tight working capital management, a lot of switching out supply chain sort of options and alternatives, much stronger risk management functions. And, whereas, we had been in various capital raising initiatives, and actually we're at the back end of a fund where we're driving exits, which have all slowed down to almost nothing, right? The transaction environment has slowed down. So a lot of re-upping in the portfolio in terms of new capital that we're putting to work to support these businesses through the J curve. And for new investments, we actually see some bright spots, or at least let's say we see some opportunities. One of our businesses, for example, is in the manufacture of cleaning materials and disinfectants and bleachers and sanitizers, hand sanitizers, which is a good business to be in at the moment. And we've seen volumes almost triple, right, in that particular business. Whereas we have another business, which is in the equipment leasing, office equipment leasing space, which volumes have declined 80% in the last 2 months, last month, actually. But the bright spots for us remain the trend lines which were already in play in the region, which will be accelerated by COVID, inclusive of sort of the tech-enabled opportunities, whether it be e-commerce, e-learning, ed tech, etc. Healthcare is a sector we're continuing to invest actively in. We have a pharmaceutical manufacturing business, for example, which we are doubling down on at the moment and making various affordable generic products. Anything to do with ICT, packaging, sort of the more defensive, essential goods spaces is where we're seeing a lot of opportunity. So as a manager of capital, we're both trying to be conservative or at least aggressive in supporting our existing portfolio, and then aggressive about looking at new opportunities that will emerge from the post-COVID environment. I'll leave it there. Thank you very much.
Thank you, Paul. Slide to stop sharing your screen. I thought it was very interesting, to think about. You let off, and you more or less told us that you can't escape it, right? Your bank in Mauritius, right, has gone under, and you're feeling it. But very interesting to see, the outlook for these countries in East Africa that really aren't as reliant on commodity exports. Obviously, especially oil and minerals. To focus your portfolio on the future. I, for one, would bet that all of the insightful and interesting commentary we've just heard has sparked more than a few questions from the audience. So I think it's time we move on to the Q&A. To moderate this, allow me to introduce Gaurav Trivedi, is Johnson MBA class of 2019, who will be moderating. Gaurav, take it away.
Thanks a lot, Matt. Really appreciate it. As Matt mentioned, I'm a recent graduate. I was also a former EMI fellow. We have been getting a lot of interesting questions, so thanks a lot. Keep the questions coming in. I'll try my best to bucketize the questions into categories and try to answer each and every question that comes in. So please keep them coming, and appreciate the fantastic work. The first question comes for Thomas. Thomas, you mentioned that there has been a massive fiscal push towards new infra projects, the likes of 5G, and also on the digital space. Wanted to get some more insights as to like the structural rejig in the Chinese economy based on these infusions, and also the impact on productivity and a potential inflationary spillover.
That's a thanks for the question. I just wanted to highlight a little bit. I'm not sure whether I capture your question exactly. I will try to answer your question because I was trying to look at the three questions posted to me through the Q&A. I was just framing my thoughts along that line. I guess hopefully that will address to the question from the broader audience. Overall, as you mentioned earlier on, or as you post, investment, China's investment in what we call the new infrastructure. That's the 5G investment. As we all know, the 5G is initially gonna sink a lot of capital, and adoption rate might be slow. But just like many infrastructure, when you build a bridge, initially first 1 or 2 years, not so many cars on the road, but that doesn't mean you should not build the bridges. And similar for the 5G infrastructure. Yes, the initial adoption rate is low, and initial capital investment is heavy, but once you put this infrastructure in, led by the government, then adoption rate will increase, and that will increase the productivity, increase the efficiencies. Overall, long term, it actually improve the overall productivity or the overall competitiveness of Chinese economy. And if we can draw the experience of the high-speed rail, nowadays, China, since high-speed rail over the past 10 years built 30,000 or 40,000 kilometers. That's bigger than all the rest of the world combined. And nowadays, it's extremely convenient, and people, because of this new infrastructure, people can move around quickly. That improve the efficiency, improve the productivity hugely. And related to this 5G investment, it's actually related to the first question, whether people are talking about whether as a result of this, the outbreak of the pandemic, whether this is a trigger for the digital health to take off. In fact, the digital health has been evolving, and people moving from offline to online to make the telemedicine, telehealth services more available. But with the adoption of 5G, in fact, it will make it more efficient because with high-speed data, the overall efficiency is getting stronger. And also, I've just taken this opportunity to answer two other questions regarding the reliability of China's data, as well as the fraud of the latest US-listed Chinese company, Luckin, Chinese version of Starbucks. I thought those are great questions. The first one is on the reliability of Chinese data versus other countries. Over my career, past 25 years, this is a very typical question coming out. My simple answer is most of the time, I would think Chinese the macro data are reliable. Of course, there are some massages, certain number of years, but overall, I just give you one example. Back in the old days, China, people were just suspecting whether China were reporting the right number on the steel, on the car. Back 20 years ago, China just produced 1 million cars, but last year, China produced 28 million cars. So imagine over the 20 years, your car production increased 28 times, and that number cannot be lied. And I specifically mentioned another number that is the Chinese, whether the government reported economy is reliable. This is again, typically as question, people are questioning whether the negative 6.8% is correct. I specifically use the data of the hydropower production, because in the end, this is a hard number you cannot manipulate. Nobody see the GDP number, but people actually can count how much electricity, megawatts has been produced on a monthly or even on a daily basis. I use data. A friend of mine, I just happen to know him. He is actually an entrepreneur, owns a number of small hydropower built along the rivers, in different rivers in China. And he told me we had a long walk recently. We cannot shake hands, but we try to walk together. Ask him how's his power production is doing. He said no, January was fine, February was down, March were actually recovered quite nicely, and April is just pretty much comparable to last year. That's good indicator for the overall economy, and hopefully that speak for the overall macro economy and macro data point. And the final question is quite interesting. There was one student audience asking me recently, SEC Chairman Jay Clayton published a statement about the concern in emerging market investment. And my point, asked my the reactions to locking fraud. For those who follow this for the market, locking probably fabricated the number, and the stock down 80% a day. It was a disaster for I think for a lot of Chinese listed company in the U.S. And I would say it triggered a lot of anger actually among the Chinese investors onshore. Even Chinese regulator were angry and they were investigated. But having said that, overall, you will be surprised among all different asset classes. There were best company actually were listed in the U.S. And if you look at the overall ADR index, Chinese shares listed in the US is actually the best performing asset classes around the world, which might sound contradictory, but I can give you one example. Alibaba, the Baba, was listed around, I think it's about 80, today is almost 200. So within the past 5 years, we're talking about one of the largest market cap in the world. Imagine if you get IPO in this company, how much money you can make. Yes, you lose money on locking or some other stock, but overall, if you buy all the IPO from day one on the market cap weighted basis or equal weighted basis, you actually make a lot of money. So bad things happen. Overall, is actually it's the best asset classes for all major investors. With that, I will get back to you.
Thanks a lot. Thanks a lot, Thomas. The next question comes on themes of globalization, and it was already facing massive political headwinds before entering into this massive exogenous shock. Professor Basu and Paul, it'll be great to kind of get your insights on the headwinds and the potential impact and spillovers that globalization is going to face, and also your thoughts, albeit brief thoughts, on the kind of recovery. Professor Basu, you mentioned it's going to be a V-shape, steep V-shape, a U-shape, the talks of different sorts of recovery. It'll be great to gather your insights from different parts of the world to get a sense on it. Over to you, Professor Basu. I think you're on mute, Professor Basu.
Okay. Thank you very much. I was also reading some of the questions, and I'm picking up, Gaurav, on the first thing that you were saying about the nature of globalization, right? That's what, and I can see someone, Leandro, has asked a question about structural changes in the world. And actually, I do have a view on that, that there is going to be one major change, which is going to affect emerging economies. We don't quite know which country, how, but this is the change that I'm expecting. Over the last 40 years, there's enough data from advanced economies and middle-income economies that the share of GDP that goes to workers as wages has been shrinking. The proportion of GDP that goes to workers as wages has been going down over the last 40 years, steadily across the world in all rich countries, all middle-income countries. And I feel during this pandemic, this is going to get a boost. This trend is going to suddenly shoot up when we begin to come out of this for the two reasons. One is we are going to be actually suddenly a more digitized world, because we would have got 6 months to a year of practice of Zoom, of WebEx, of retail purchases, which anyway was picking up using platforms to buy. And you can see from how well the platform corporations are doing that the platforms are going to be hugely important. So what we are going to see is the rise of digital technology, which means outsourcing is going to become bigger than what it was earlier. And my expectation is countries that are able to take advantage of this are going to come surging out when we get out of this crisis. Right now, we are in the middle of the crisis, so there's going to be a big change. There was another question from Devi Mishra, I think, which is on the sort of revenue and fiscal situation. Should I quickly answer that, or do?
5 seconds.
Okay, well, I'll tell you. The revenue situation and the fiscal budget of the Indian government will come under strain, as for all governments. India has a FRBM Act, Fiscal Responsibility Act, quite a sophisticated one, which allows the government to exceed its fiscal limits under natural calamities or national security. So that can be invoked, and the fiscal limits can be made easier for the government to be able to tackle this, but this is a global problem. Yeah. We do expect that the World Bank and the IMF, international organizations, will come in and provide some support as well.
Thank you.
Yeah.
Paul, your comments?
Sure. Maybe there's one or two other questions coming up. I will share the slides for those who are interested. And yes, we're continuing to invest, and we are actively looking at some of the sectors that are highlighted as growth opportunities in this space, which is sort of tech, healthcare, and essential services, goods and services. Look, do we think it's going to be a V shape, W shape, U shape? You know, it's a little difficult to judge. We are hopeful that it will be a U shape, and because I don't think we will have a V shape. I don't think we have the capacity to stimulate the growth as rapidly as we might have wanted had we had the sort of financial fiscal wherewithal to do it. So to me, the best case is a U curve, and that is on the assumption that we do contain the virus. And I am hopeful that we will, and steps are being taken to ensure that's the case. So for both of those things, I think we're looking at maybe a 12-month sort of U shape, and hopefully sort of middle of next year, you know, we'd expect to have a bit more of an upbeat view. I think that the other question was around globalization. Was that the other question?
That's correct.
Yeah, look, you know, I think there'll be less interest in Africa going forward, which may not be a bad thing. But I do feel that certainly with China coming back strong and you know, looking to play, I think, a greater role on the global stage, I think the relationship between Africa and China particularly will continue to be a complicated but you know, evolving one, where I do think that despite, and one of the questions was, you know, are we concerned about some of the backlash around the China-Africa relationships, around some of the discrimination in China of Africans in association with this COVID. Look, I think that's emotional, and I do think that as a factor. I've seen factories being burnt in Nigeria, and I've seen a few reactionary events. But at the macro level, I do feel that Africa will need China, particularly as the rest of the world shrinks into their cocoons in Europe and in the US. I think they feel that they've got their own problems, and they're much less global in their outlook. So with the soft power being exercised by China more and more, we think that relationship will naturally have more pronounced going forward.
Thank you very much. Taking cognizance of the time limitation, I think that's the time that we have. Apologies up front for all the engaging questions, and a special thank you again for sending all the questions, engaging questions, and of course, a bigger thank you for all the panelists who were able to not only provide the insights, but also the rich Q&A session. Now, I would like to pass the baton to Lourdes to sum up today's session and of course, give her final words of wisdom.
Thank you very much, Gaurav. It was really interesting between a V and a narrow U. We finished on a very optimistic view. I also like the connection. We started with China, India, and Kenya in Africa, and the connection is there because relation with between China and India and Africa, a lot of South-South is going to happen of trade and development and investments, and that's always good news. So thank you all. I would like to pass the word to Matt for the very closing comments. Thank you all, Gaurav, Matt, and the speakers, Kaushik, Paul, and Thomas.
Thank you.
Thank you, Lourdes. On behalf of my co-organizers, as well as the entire Emerging Markets Institute, its fellows, alumni, and supporters, thank you all so much for joining us today. And of course, a special thank you to our panelists, Thomas, Kaushik, and Paul. Today was thought-provoking and uplifting. I would invite you all to please stay tuned for details on upcoming programming from the Emerging Markets Institute. And with that, we're going to close our session for today. And so until next time, I'm Matt Douglas. Thank you very much.
And thank you also to IT services who have been monitoring, and everything has gone extremely well. And thanks to them. Thank you, Matt, for joining today.
Thanks, everyone. Cheers.
Thank you.
Thank you.
Thank you, Paul,
Thank you.
Bye.
Thomas, and Kaushik.
Bye-bye.